Hello there. Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I'm Rose Marcello, and I'm a client portfolio manager with IGAM. My guest today is David McCullough, portfolio manager, fixed income. Alongside Alexandre Morin, David manages about 20 mandates within fixed income, among which IA's flagship core Canadian fixed income mandate. Good morning, David.
Morning, Rose. Thanks for having me on.
Thank you for being here and Happy New Year to everybody. So today, what I'd like to discuss with you is we've seen a formidable rally in bond prices in Q4. So I want to discuss what do you think the next steps are for central banks and implications for asset allocations and bond portfolios. So tough year into up to end of Q3 2023, then a material rally in Q4. In your opinion, what was driving that rally, and was the move according to your expectations?
Yeah, I think in answering that question, it's really important to look at the factors that cause rates to move up almost 1% higher in the first 9 months of the year. And really that move higher in rates were driven by three things. You had growth and inflation, you had monetary policy, and then bond supply. So, and looking at them piece by piece. So growth and inflation, looking back last year, most market participants were expecting a recession last year. And in contrast to that expectation, growth actually came in much better than expected, and inflation remained elevated longer than expected throughout the year. On the monetary policy front, central banks, whether it was the Bank of Canada or the U.S. Federal Reserve, in their fight against inflation, raised rates much more than consensus was expecting through the first half of last year. And in their communication, they really emphasized that rates would be higher for longer and that they would be very persistent in their fight to get inflation lower. And then finally, bond supply. So in the first 3 quarters of 2024, government bond supply and primarily U.S. Treasury supply was higher than originally expected. So that's what drove rates higher from January to September. And then it was really those same 3 factors or the reversal of those 3 factors that contribute to a very strong rally, over 100 basis points in yields in the fourth quarter. And so looking at each of them again, growth and inflation, what we saw in the last several months of last year, we had seen weaker than expected economic data, pointing to slower growth, a softening in the labor market, and a decline in the level of inflation. On the monetary policy side, what we saw was a change in tone from both the Bank of Canada and the U.S. Federal Reserve, suggesting that their hiking cycle was over and that they would be cutting rates in 2024. And many global central banks also shifted their tone, so that contributed to a strong rally. And then finally, bond supply. We received a fall funding update from the U.S. Treasury, and it showed lower than expected increase in their borrowing requirements going forward. So all these 3 factors really contributed to that material fourth quarter rally that you pointed out. From an investor's perspective, very positive, because if you looked at year-to-date returns in the bond market in Q3, they were negative, and we ended the year on a positive footing.
Good to hear. And so going into the fourth quarter, how are you positioned and how well did the portfolio benefit from that positioning in that rally?
Yeah, so let me touch on a few aspects of our positioning. I'll touch on duration, credit, and then municipal bonds. So duration, given that we had a very positive outlook on bonds, we were overweight duration across our portfolios, and this was a benefit to the portfolios as bond yields moved lower. On the credit side, we were overweight high quality credit to start the quarter. We found the overall level of corporate yields very attractive in an environment where corporate bonds generally perform quite well. And then the incremental yield from corporate bonds, as well as their outperformance of corporate bonds relative to government bonds, also benefited the portfolios. And then finally, on the municipal bond side, we were also overweight unrated bonds issued by municipalities in Quebec. These bonds provide excellent levels of yield without bearing much interest rate risk.
Good. And did you reassess by year end what changes were made and starting the year? How does it look like?
Yeah, absolutely. We're constantly reassessing. Every day we're looking at markets and looking at both the risk and the reward of our positioning. And Q4 was no different. So we were quite active in the quarter across many aspects or elements of the portfolio. For example, in our provincial exposure, we moved from a neutral weight in provincial bonds to a modest overweight throughout the quarter as provincial bonds spreads reached their year-to-date highs. And then in December, after the head rallied considerably, we took profits and moved back to a more neutral position. We are also active in our corporate bond exposure. We added some shorter-dated corporate bonds to the portfolio early in the quarter. This benefited from a nice year-end rally. And then after that rally, we decided to take some profits, reduce our corporate bond exposure. We're still modestly overweight, as we still expect the economic environment in the near term to be supportive of credit here. And then finally, on duration, we are quite active in managing the portfolio exposure to interest rate risk throughout the quarter. So as rates moved higher in the third quarter, we added duration portfolios. In the fourth quarter, as bonds rallied, we took some profits and reduced that exposure to interest rate risk. And if you look at the portfolios right now, we're currently neutral relative to our benchmark, and we'll continue to be very tactical in the duration management.
Okay, so you're a bit more conservative to start the year. What should we see in that kind? What's your outlook for the next quarter or so?
Yeah, well, we still have a very positive outlook on rates. Bond yields are still at multi-year highs, and we continue to believe that bonds offer a very attractive risk-reward profile. And what's supporting this view is that we do expect growth to continue to slow in 2024, and that inflation should continue to move lower, causing central banks to lower their overnight rates. The risk to this outlook is that inflation remains stubborn, growth comes in better than expected, or governments issue more bonds than currently is expected. And while we do have a very positive outlook for bonds, one thing we do expect to see is continued volatility in the bond market. So driven primarily from markets pricing of central bank cuts in 2024. So we think the market is being too aggressive in both their timing and the magnitude of rate cuts. And if we're correct in this assessment, we could see a repricing not only of yields moving higher, but also risk assets as central banks overnight rate cuts get priced out compared to what's priced in right now in the market. So I'd say on a positive note, the nice thing about volatility, it does afford portfolio management opportunities. So it'll afford us the opportunity to be active and tactical in our positioning, as was the case in 2023. Looking at the yield curve, I think we believe the current inverted yield curve is going to begin to steepen materially once central banks begin cutting policy rates. So that'll create even more tactical positioning opportunities going forward. And then, as I said earlier, we still have a positive outlook on credit in the near term. However, its risk reward is less compelling today than a few months ago, given current valuations.
Good. So you do expect rate cuts to come in sometime this year, but volatility will be there still. But that's also the name of the game in an active mandate, is like it allows you to be that active and tactical. Any final thoughts you would like to leave us with?
Yeah, I would say one last final thought. Based on our outlook, we believe bonds will perform well this year. And given that, I would say if any of our partners in sales would like to hear more about our views and outlook, I'd invite them to reach out for yourself. Our team would be more than happy to share our thoughts with them and their clients.
Good. Thank you for availability and the generous offer.
My pleasure.
Thank you so much, David, for being here today.